Welcome back to The Explainer. So today we are unpacking a massive hurdle for pretty much every growing business in Canada: how to actually afford heavy machinery and capital assets. Because let's be real, whether we're talking about a massive CNC machine, a whole fleet of dump trucks, or a fully tricked out commercial kitchen, the capital cost is absolutely staggering. It's like a giant puzzle. How do successful Canadian businesses actually pay for this stuff without, totally bankrupting themselves on day one? Well, that's exactly what we're going to reveal right now. But before we get to the actual strategy, let me just ask you the burning question that pretty much every business owner secretly has when they start Googling this topic. Tell me the truth. Are you looking for a 100% free equipment grant? Okay, let's dive into this, because I kind of need to give you a harsh reality check here to reset your strategy. Free government money just for buying equipment? It's largely a myth. Out of the hundreds of government programs out there, true, non-repayable grants specifically for equipment are incredibly rare. I mean, they barely exist. But hey, don't panic, because today we're going to show you exactly how Canada actually funds equipment. We've got 5 quick steps today. Number 1, the free money myth. 2, Canada's funding ladder. 3, the leasing alternative. 4, anatomy of a lease. And 5, the capital stack. Let's jump right in. All right, starting with section 1, the free money myth. Let's fully debunk this whole expectation so we can focus on what actually works. So, the data from Grant Compass really hits the nail on the head here. After doing a deep dive, they found that out of 18 major equipment-relevant programs in Canada, only 4 are true grants. Actually, to put it bluntly, true non-repayable grants for equipment purchases are exceedingly rare at the federal level. Instead of handing out free cash, the vast majority of government funding flows through government-backed loans, tax incentives, and conditionally repayable contributions. So you might be wondering, how does the government actually help then? Well, rather than just writing you a check, they de-risk the purchase for banks. Take the Canada Small Business Financing Program, or CSBFP. It is essentially the anchor program in Canada. When you go to your bank for an equipment loan, the federal government steps in and guarantees 85% of that loan. That means the lender is only bearing 15% of the risk. Because of this massive safety net, banks are just significantly more likely to approve your equipment loan, even if you're a startup or maybe lack heavy collateral. Okay, now that we know grants aren't just falling from the sky, let's move right to Section 2, Canada's funding ladder. We need to map out the actual hierarchy of how you should pursue this funding. Think of this as literally climbing a ladder, starting from the easiest bottom rung. Step 1 is tax deductions, specifically the Accelerated Capital Cost Allowance, or CCA. This is a big one. It lets you write off 100% of the equipment cost in year 1, which immediately drops your corporate tax bill by up to 26.5%. Boom, instant savings. Step 2 introduces those government-backed loans we talked about, like the CSBFP. Then Step 3 hits provincial grants, which are strictly limited by your location. And finally, the top rung, innovation programs like IRAP. These offer massive funding, sure, but only if your equipment is for experimental R&D, not just your regular day-to-day production. Let's actually look a little closer at rung 3 with a quick provincial grant reality check. Because wow, the amounts and eligibility vary wildly depending on where your business is located. For instance, if you're an agricultural processor over in Saskatchewan, their SLIM program offers an incredibly generous grant of up to $750,000. But literally right next door in Alberta, the Manufacturing Productivity Grant caps out at a very modest $30,000. Meanwhile, British Columbia goes a totally different route, offering a 15% refundable tax credit. Bottom line, location is literally everything when it comes to free money. But what happens if you don't neatly fit into these rigid government boxes? That brings us to Section 3, the leasing alternative. Let's be real for a second. Government loans like the CSBFP have some pretty strict rules. The lender still decides if you get approved, and honestly, the paperwork process can take weeks. If you have bad credit, or maybe a prior bankruptcy, or maybe you just need heavy equipment instantly so you can outbid a competitor, you're going to need the commercial leasing market. Firms like Moneyline Capital over in Kitchener specialize in exactly this. They offer the kind of flexibility that government programs just can't match. We're talking fixed payments that never fluctuate, lightning-fast 24-hour approvals, and crucially, they approve equipment leasing for businesses with bad credit or past bankruptcies. It is a fantastic alternative path when the traditional funding ladder is totally blocked. Now, whether you use a traditional bank loan or you go with a commercial lease, you're going to be signing a mountain of paperwork. Welcome to Section 4, Anatomy of a Lease. Let's do a little document autopsy. Let's ground these abstract concepts in absolute reality by looking at an actual official master lease agreement. This specific document is between the Royal Bank of Canada, acting as the lessor, and the City of St. John, acting as the lessee. When you finally pull the trigger and acquire equipment, this is exactly the kind of dense legal framework you are legally binding your entire business to.
Now, what's really interesting about this slide is the sheer weight of the fine print we extracted directly from that RBC document. The obligations are incredibly strict. Think about this. The bank retains exclusive ownership, yet you, the lessee, have to pay for all the maintenance, all the repairs, and you have to provide all risk property insurance. But here's the real kicker. You bear the total financial risk. If that equipment is completely destroyed or stolen, you are legally on the hook to immediately pay the bank the discounted aggregate amount of all remaining installments, meaning every single future payment you owe becomes due instantly. You carry the absolute burden of ownership without even holding the actual title. Crazy, right?
And just to grasp the sheer scale of what we're talking about here, consider the rental statement from this exact same RBC lease. The City of St. John acquired 60 self-contained breathing apparatus units. The net equipment cost, a massive $657,609. That locked them into a strict, unyielding monthly payment of over $7,700 for a solid decade. This is exactly why you absolutely must have a rock-solid funding strategy before you even think about signing on the dotted line. Which brings us to the climax of our explainer, Section 5, the capital stack. This is the secret sauce for how you drastically lower your out-of-pocket costs. The trick is, you don't just use one program, you sequentially layer them. It's like building a capital sandwich. Take this real-world scenario for a manufacturer out in Alberta buying a $500,000 CNC machine. Step 1, they secure a $500,000 CSBFP government-backed bank loan to cover the entire upfront purchase. Great. Step 2, they successfully apply for a provincial manufacturing grant, which lands them $25,000 in non-repayable funds. Free money. Step 3, at tax time, they claim the accelerated CCA, writing off 100% of the equipment in year 1. That results in $115,000 in immediate tax savings. So let's look at the final math, because it is incredibly powerful. You take that original $500,000 price tag, reduce it by the $25,000 grant, and then subtract the $115,000 in tax savings. Drumroll, please. The net effective cost of that CNC machine drops down to $360,000. By understanding how to stack capital, this business owner effectively dropped the real price of a $500,000 machine by a massive 28%. Yes, the loan itself is still repayable, but the true out-of-pocket burden on the business is completely transformed. That is a total game changer. So, we've busted the myth of free money, we've climbed the funding ladder, analyzed the frankly heavy obligations of a commercial lease, and finally, showed you exactly how to mathematically stack government incentives to slash your effective costs. Which leaves us with one final empowering question to ask yourself before you make your next major equipment acquisition. Are you ready to stack your capital? Thanks so much for learning with us today on The Explainer, and we'll catch you next time.